UPS has lost a significant amount of its market cap just over the last few days. It is down 11% year to date with a very attractive starting yield over 4%. In today's episode, we're going to look at whether we are seeing a severely undervalued price for the United Parcel Service Incorporation. Is there some strong upside to this company? And can we see this yield that is currently over 4% grow into double digits, 10, 11% over the next few years? We're going to look at the historical performance of UPS. We are going to dive into their income statement, look at their top line revenue growth year over year, as well as that bottom line net income growth, see how that has performed and how the performance of the company is doing as a whole. We are going to dive into their balance sheet, taking a look at their cash versus their total debt to see how secure that effective dividend is. We're going to look at the dividend safety and some very important financial metrics to back up United Parcel Services that will then help lead whether or not this is a great business to own. And finally, we will run it through our stock valuation model, getting to our intrinsic value for UPS, our acceptable buy price given our margin of safety. And I will run through my thoughts on the company and what I am personally doing with regards to investing in UPS. Now, year to date, it is down 11%. What we can see is right there at that 52-week low. However, as I always say, 52-week low does not signal undervaluation. Likewise, neither would a 52-week high. Now, it has got a very strong starting yield, well over 4% now. And for those investors who have held the company over the last 10 years, they would have seen around 76% growth. Now, it's not the greatest return on your investment over the 10-year period. Granted, this doesn't include that forward yield. But what we really want to be asking ourselves right now is this severely undervalued, and can we see some strong yields over the next 3-4 years? That yield on cost growing and growing. Now, in terms of the income statements, well, what do I look at? What do I like to see? That top line around 3 to 7% growth year on year. Now, when we take a look at the December 2018, we see around 71.9 billion on the top line reported. December 2022, 5 years later, around 100 billion. So it is positive. It has been growing over the last 5 years. On top of that, we can see revenue growth has been consistent year on year. And shortly we'll look at the 10-year growth percentage wise. Now, in terms of the bottom line, that net income, well, what we like to see is increases year on year as well as moving in the right direction. 4.8 billion on that bottom line net income in December 2018. What we see December 2022, 5 years later, around 11.5 billion. So nearly tripled that bottom line over the last 5 years. Very, very positive to see. But when we look at a more granular level, what do we see? Well, 2018 to 2020, it has in fact decreased year on year. It then does pick up enormously in December 21, and then it does drop again in December 22. So there are some inconsistencies on that bottom line, which we would need to investigate. But overall, one of the main reasons and one of the main positives that we can see is that revenue is constantly growing. Now, in terms of the balance sheet and a quick snapshot, total cash versus total debt, 5 billion in terms of cash and short-term investments in December 2018. Latest quarterly report, what do we see? Around 7.9 billion. So they are holding on more cash over that 5-year period. And in terms of the long-term debt, or the total debt in fact, and how that has moved numerically and directionally, well, we can see total debt 22.8 billion in December 2018, and latest quarterly report around 25.1 billion. So they have increased their total debt slightly, but you could argue they've also increased their total cash position, as we can see here. So some positives and some things just to understand and think about as potential investors. Now, in terms of that all-important dividend safety, they did get a 69 score, making them safe. Market cap, 134 billion, meaning they are a mega cap company. As always, for those that do believe we're heading into a recession, well, 07-09 period, they maintained their dividend. They didn't increase it. However, they also didn't cut the dividend. Negative 13% recession sales. Yes, it's not the greatest, but when you compare it to companies in the S&P 500, this was roughly the average growth for that same period. And then when we look at the recession return, Negative 48%, again, not great at all. But again, when you compare it to the S&P 500, it did beat their negative 55% return from the same period. So some things just to digest there for those that do believe we're heading into a recession. Now, dividend growth, first thing to note, they have been paying increasing dividends over the last 13 years. Latest increase at the beginning of this year, 6.6%. Now, why do I like that? Well, as I always say, you are looking for a minimum of 4% as the baseline for any increases in your salary, dividends, and other income-producing assets. Now, why do I always keep hammering on about that? Well, that is because the US inflation rate over this 40-year period was 4%. Anything less, you're taking a pay cut, losing your purchasing power. Now, it's very, very nice to see double-digit dividend compounded annual growth over the last 5 years at 13%. Likewise, over the last 20 years at 11%. So again, very, very positive to see. Now, dividend yield theory does state that a company is undervalued when that current yield sits above the 5-year average, as we can see here, 4.14 versus 3.3. One sign of undervaluation. However, I do always say we don't like to look at any model in isolation before drawing our conclusions, which we will wrap up towards the end of the episode. Forward PE is slightly higher than the 5-year average, 16.5 versus 15.6. And we can see the sector PE coming in at slightly higher than the PE for UPS. As mentioned at the beginning, it is there towards the 52-week low. Now, earnings versus free cash flow. Regular viewers know we ignore the earnings purely based on the fact that earnings is susceptible to manipulation by management through accounting. Quick example, 2019, free cash flow generated. We can see here 147% of what essentially the free cash flow was generated by UPS was paid out as dividends, is a red flag indicator. 2019, you'd look here and you'd think that that is a decent year. So, free cash flow, let's just take a very quick look. I always like below 60%, as that means there is room to grow that double-digit dividend that we love to see. Consistently around that 60%, again, a year, as I mentioned here, where they were paying more in dividends than they generated in free cash flow. From that point, 69% in 2020, 33% in 21, 57% in 2022. Again, positive years, these last 3 back-to-back years. However, red flag indicator straight away, 2023 is expected to be 92%. Bit alarming in my personal opinion, and it could mean that in the January 2024 dividend increase, we may not see as generous as we saw this year. So do bear that in mind, but you could also argue you are receiving a 4% plus yield as it stands. Now, in terms of the earnings per share, again, not something I personally take note of. Free cash flow per share, $5.57 in 2013, $10.70 in 2022. So some nice growth over that period. It is going in the right direction. However, again, inconsistencies. We can see years where it has decreased and then gone up. And we can see this negative year in 2017. So it does look to be a fairly inconsistent business. And another red flag indicator, they are expected to quite significantly drop that free cash flow per share in 2023 down to $7.04. Now, sales growth is a positive with UPS. I do like to see 3 to 7% growth year on year, as really makes sense. A minimum of 4%, you could argue, due to just keeping up with inflation. What we see over the period, we do see consistently between 3 to 7%. Granted, we see some years where there was flat and below that, but we also see years not only above that 3 to 7%, but also years where we see double digits. Now, numerically, around $55 billion in 2013, nearly doubled their revenue over the last 10 years to $100 billion. So that is positive with UPS. Now, shares outstanding, we do love it when companies do share buybacks, returning excess cash to our shareholders. 948 million in 2013, 875 in 2022. No real share buybacks, very small amounts year on year. Better than nothing, but still nothing really to drive home or to really talk about. ROIC, one of my 7 golden dividend metrics. The other 6 you can see on the pinned YouTube video. Above 10% is what I love to see, as it means management are able to effectively allocate that capital. Consistently above that year on year, very, very strong plus for United Parcel Services. So again, this does give me faith in management, and it is a very positive to see. If you've seen other episodes on the channel, you'll note that not all companies can get that consistent double-digit ROIC. Operating margins around 12%, likewise free cash flow margins around that year on year over the last 10 years for UPS. Some years we can see where they've struggled, but they have straddled a percentage point or two above and below what we like to see. Likewise, the same can go for the free cash flow margin. Now, in terms of their net debt to earnings before interest, tax, depreciation, and amortization, whilst we like to see it below 3, which is the number of years it would take the company to pay off their debt net of cash on hand, from 2018, it looks like they have really dropped that figure all the way down to below 1 in 2022, with 23 expected to creep up slightly higher than 1, but still very strong for this company. Net debt to capital just showing that 46% of the company's financing in 2022 was essentially from debt as opposed to equity. As always, if value is being provided and you are enjoying the content, do hit that like button and do subscribe to be continually notified of these videos directly dropped to your doorstep and join this lovely community. If you want to run your own companies through the valuation model, also click the link below in the pinned comments and grab yourself a copy to run your own companies through these models we're about to go through. Now, Graham's valuation, typically we have the stock ticker, we have the earnings per share for UPS, growth rate per analyst estimates, and that yield on AAA corporate bonds. Now, this would give an intrinsic value based on Graham's valuation for UPS at $101. Now, we can see that's significantly lower than the current trading price, well below the 52-week low. And personally, I don't believe for this company it is appropriate to use Graham's valuation. Now, I've run through it so you can see how we essentially use this, but it's not something that we're going to be including in our final intrinsic calculator at the end of the episode. Now, the multiples valuation model, what do? We use companies in a similar sector and size. We have FedEx Corporation, JB Hunt, and CH Robinson. We have their stock price, earnings per share with their PE multiples laid out here. We get the average multiplied by the earnings per share of UPS to get a multiples valuation model price of $224 for UPS, signaling upside to the 52-week high as well as some strong upside to the current trading price. So you could argue, based on this model, undervaluation. Now, the dividend discount model, very nice increases over the last few years, as we can see on screen, just under 14%. Now, forward looking, I have gone for 5%. As we can see, that's essentially lower than this periods other than 2 years ago. But as always, this is based on my own estimates and judgments. If you want to run your own estimates and judgments through to see what your DDM price would be alongside the other formulas we've run through and are about to run through, do grab a copy of the model in the comments below. Now, this gives a DDM price of $227. As we can see here, again, significant upside to the 52-week high, showing signs of undervaluation to the current market value. Now we're moving on to the final model, the discounted cash flow model with free cash flows year on year. Average growth rate negative 37%, not the greatest, but we can see some years where they really did struggle, 2017 being one of them. But again, we can see other years where they did pick up very strongly. Forward looking, analysts are estimating around 3 to 4%. With a discount rate of 8%, we get the present value of future free cash flows and terminal value. Add these together with the cash, subtract total debt, and we arrive at our equity value. Divide that by the shares outstanding, we get a DCF price of $193. As we can see, just below that 52-week high, again showing signs of undervaluation. As always, if you are enjoying the content, do hit that like button. It really helps the channel, and do comment along we go with the video. Now, again, if you are enjoying the content, like, subscribe, and if you want to grab a copy of the model, check the pinned comment below. The intrinsic value is essentially the average of the 4 models we have just run through. However, as mentioned, we will be excluding Graham's valuation from this intrinsic value calculation. This gives an intrinsic value of $214. If we take a very quick look, very high upside to the current trading price and above that 52-week high. Now, in terms of the current price, as we can see here, $156, quite some difference to the intrinsic value. Now, typically, margin of safety, if you're regular viewers, you know 10% would be used for a company with a wide moat, strong financial metrics, and good forward-looking data. Now, personally, I believe you need more for UPS, especially given the union issues that they have had. So I personally would be going for a higher margin of safety. Now, acceptable buy price around $193 if you were looking at 10%. 20%, your acceptable buy price would be around $171. And for those who are looking for even higher margin of safety at 30%, well, your acceptable buy price would be around $150. Now, personally, this is one that has been on my essential watch list for quite some time. It was on my watch list at $160. However, personally, given the issues that they have had at UPS, I'm looking to increase my margin of safety to around 30%. So it is on my watch list at $150, and I will be looking to add this into my portfolio once it reaches $150, as this isn't a company or in fact an industry I have in the portfolio. As always, let me know your thoughts below in the comments. Are you looking to buy, UPS, sell, or purely on the sideline speculating? In terms of Wall Street, well, they are forecasting some very, very strong upside to around $194.50. Don't forget to like, subscribe, drop your comments below. Catch you on the next episode and have a lovely, lovely day.